Good afternoon, ladies and gentlemen, and welcome to the Fund Intelligence Podcast. I'm your host, Kamaljit Somohe, lead analyst at Dunhill Financial. Today, I have with me a very special guest who I'm sure some of our longer-term clients may recognize from our friends over at Montanaro. I have the pleasure of introducing Cedric, the CEO at Montanaro Asset Management Limited. Welcome, Cedric. Now, for those of our clients who haven't quite heard of Montanaro, why don't you give us a little introduction about yourself for our audience?
Of course, and first of all, thank you very much for inviting me, and good morning or good afternoon to all our listeners. So you asked who we are. I suspect that some of you will have heard of Montanaro, others not. We're basically a boutique asset manager, specializing in global quoted small and mid cap. That's all we do. And the name Montanaro itself actually comes from Mr. Charles Montanaro, who founded the business 30 years ago in 1991. So this is actually a very special year for the company. Charles is 65 today. He's still very much involved in the business as executive chairman of the board, as chairman of the investment committee, and also as a fund manager. You might also wonder why Montanaro has a very Italian ring to it. That's simply because the name originally comes from or has Maltese origins going back several centuries. But for those of you who have met Charles, you'll know that he is very British. In terms of the background, basically in the 1980s, Charles had worked at various firms, Merrill Lynch as a broker. He worked at Drexel, where he came across the infamous Michael Milken. He'd worked in private equity at M&G Petrikov, which you might know as Apex Partners nowadays. And it was towards basically the late 1980s when he was in private equity that Charles started to realize that institutional investors in the UK were hardly dedicating any resource or even interest really to quoted small cap, and they were leaving that asset class to be covered by the most junior people in their team. This all happened at a time when academics, both in the US and in the UK, had recently discovered the small cap effect, and the small cap effect being the fact that smaller companies tend to outperform over the long term. And so seeing this, Charles decided to set up his own business, and the purpose of that business would be simply to invest in small cap on behalf of institutional investors. And so here we are in 2021, 30 years later, nothing's changed. All we do is still investing in small cap. We've added mid cap, but that's very much an extension of small cap investing. And you know, we're still we have no plans to sort of branch out into any other asset classes. And I guess if we fast forward to today, we have a team of 34 people, which makes us one of the largest small and mid cap specialists in Europe. Almost all of us are based in the heart of the city of London, just by the Bank of England, so it's a very, very nice location. It's a very different culture to what you might find elsewhere in the city. I think it's a culture again that's been shaped by Charles himself from the very early days when the company was first founded. I think one of those characteristics is that people don't take themselves too seriously.
That's some great insights there into Montanaro, I'm sure for some of our audience there. So the next question I have is, what sets the Montanaro family of funds apart from the other competitors? What's the edge?
Yes, that's a very good question. I guess there are a few things that sort of set us apart from other managers. I know all managers like to think that they're very different to everyone else. So you know, just to be clear, we're not different in everything we do. But I think that where we are truly different is, firstly, there are no conflict of interest in a boutique like ours, because all we do is small and mid cap investing. So there's no struggle internally for resources. we all we do is basically work for our clients, and it makes things so much simpler on a daily basis. I think the other point I would highlight is the fact that we have one single investment philosophy, which we call quality growth, and that philosophy is applied to all our funds. And it's applied with the same investment process as well. So again, as a client of Montanaro, whichever product you buy into, you have the certainty of knowing that you buy into the same investment process, the same investment approach, and all of that delivered by basically the same team. Another point really is around the fact we're truly long term. I know a lot of managers like to say that, but it is something that we're very keen on. We have, we're still invested today in companies that we first bought 20 years ago, and the reason is simply that when we first meet a business, our questions are really about where the business is headed over the next 10 years, what gets management excited, whether whether they're truly committed to the business. We don't have much interest in what's going to happen next quarter or even over the next 12 months. We're really interested in the long run. And the turnover across all our funds, again, regardless of which one you invest in, is somewhere typically between 10 and 20%. So it's quite low by city standards. And then maybe I'd add two more points. One is the fact that we have, I'd say ESG or sustainability has been part of our DNA for forever. It's been fully integrated into the investment process ever since 2005. 2005 was the year that we won a large mandate from the Church of England. And that was really the beginning of the formalization of our ESG process, and obviously there's more and more focus from investors on ESG nowadays, and it's just obviously it's nice to be ahead of the game on that front. And finally, I would just also highlight the fact that we were very lucky to have such a large team. I said 34 people. That includes a team of 12 analysts, and they're all sector specialists. If you were to look at our organizational chart, you'd also notice that there are lots of different flags, and most of the key nationalities in Europe are represented within the team. We have a number of many Brits, but we also have people from Spain, from Germany, from France, from Sweden, and even an American, and a few other nationalities, Greek included. And this is deliberate. It's because we like to have people who understand the local culture, who are able to go and meet management, meet the companies on site, and really get a proper understanding of how they operate, of what the culture is. And you don't really get that, if you're not used to the local language or your local culture. So I'm French, and I would quite often basically travel to France to meet French companies, just because I find it that much easier, perhaps, compared to British analysts to engage with management. I'm highlighting this because part of those visits are absolutely a critical part of our investment process. We don't just do desk-based analysis and calls with management. We clearly meet top management, but we also like to look much beyond that, and meet a sort of middle ranking management, and just walk the factory floors as well, just speak to people, just get a sense of how busy they are, and how whether it's a nice place to work, etc., just to see, to get a sense of whether people are happy as well.
Yeah, no, definitely. Those are some fascinating insights there. I think, especially in today's space where, as you mentioned earlier, a lot of, boutique funds focus on desk side research only. How important would you say is, going out there and visiting the funds that you invest in and getting, boots on the ground per se?
I think it's hugely important. Clearly, over the last 12 months, no one's really been able to do much of that, and so we had to be innovative. We've had some companies who were able to organize virtual site visits, so we've experimented there. But I would say that nothing really replaces the what you get from visiting from a true sort of on-site visit. We've you can if you're a short-term investor who's looking for upside over the next 6 to 12 months, a visit won't really teach you a huge amount. But if you're a long-term investor, then it really will, because one of the issues is that management teams tend to be pretty well versed into speaking to the city, and they do meetings with investors all the time. But it's really important to be able to look beyond that and see what the reality on the ground is. If management tells you they're very, very busy, and then you actually get to the factory and you realize that actually half the people are off, and the machines are not working, then clearly that's pretty good grounds for some questioning. We've had a case of a company that we went to visit because it was a new idea we were thinking about. This one was actually in the southern hemisphere, and the analyst turned up, and basically the entire floor was empty, and the plants were dead. And when this sort of thing happens, you think it makes you wonder whether something is potentially wrong. And it's especially important with smaller companies, because the culture, the management team have a very significant impact on the success of the business. And so that is why we would always go and visit every company we invest in.
Perfect. And then the last sort of question I have is, how is Montanaro best positioned for 2021 and the years ahead?
I think I'll probably answer your question in sort of two different ways. If we look at the years ahead, I think the asset management industry is increasingly competitive, because of the very rapid growth in passive products, which are driving down fees, and just because there's so many players around that it's difficult to sort of stand out. I tend to think that specialist boutiques will like Montanaro will be able to thrive despite this competition, simply because we'll be sticking to what we know, and therefore it's very important to have ambitions that are realistic and that you can stick to. So that's why at the beginning I was saying, we have no plans of branching out into other asset classes, be it large cap, be it fixed income, credit. These are areas which are perfectly interesting and very interesting asset classes for other managers, but not areas that we know anything about, and so we're very conscious of that. Where we think we are pretty good is in identifying high quality smaller companies, and we'll carry on doing that. There are no structural changes within our own market that tell me that things will be different in the next 10 years compared to the last 10 years. If anything, there's less sell-side coverage since MiFID II. So there's, on average, less sell-side research out there in the public domain, which means that if you have the resources to do the research yourself, then you're in a better position than the rest of the market. And that's clearly an area where we can differentiate. So I guess the future for us is going to be still very much in quoted small and mid cap. the business started focusing only on the UK market. In the year 2000, we started investing in continental Europe, and in 2018, we branched out into global developed markets. So basically, US, Australia, New Zealand, Hong Kong, Canada, and a few other markets. And at the moment, that's enough for us. We've got plenty to do in that space. So no plans to do anything else. You asked about 2021. Now, 2021 is actually interesting because this is where perhaps I should probably comment on the style rotation that everyone's aware of that we've seen since November. Just to sort of recap what's happened. In November, we heard the news of the Pfizer vaccine and then all the other vaccines soon after that, and that prompted a very, very significant rotation in the market out of high quality and growth companies into low quality and value companies, and that accelerated in the first quarter this year. And you can see that, if you just look at what sectors have done has the start of this year. Well, the best performing sector has been energy. It's up 20%. Metals and mining are up 17%. Financials, especially banks, they're up by 10 to 18%. And amongst the worst performers, you find healthcare, which is down 4%, and IT, which is flat. And so, typically, as a quality growth manager, we like companies in the healthcare sector, in the IT sector, because they tend to offer very attractive long-term structural growth opportunities. But they've been completely out of favor now for the past 4 months. And this is, I'm mentioning this because it means that this quality growth style is much more attractive today than it was 4 months ago. It's much more affordable, and clearly our funds have underperformed in the last 4 months after having had 3 or so exceptional years. So it's very difficult to say what 2021 will look like, but all I can say is that as the rotation progresses, there will be more and more interesting entry points into our various funds.
Mm-hmm. Well, thank you very much, Cedric, for taking your time to be a part of this. We very much appreciate you coming on here, and please do send our best regards to the rest of the team at Montanaro.
Will do, and thank you very much for inviting me.